The third type of ETF are defensive ETFs. And when I say defensive ETFs, I don't just mean defense stocks and war stocks. I mean stocks that generally people still need when markets go down. This could be things like your toothpaste, your soap, the Coca-Colas, the Walmarts. These are the necessities that people still spend money on even when there's a recession going on. So I'm going to break this up into a few different categories. That way we can understand an idea of different ways to play this defensive trade. More specifically, I want to talk about investing for dividends, because when people are concerned about markets going down, they want safety. And dividend-paying companies are generally the safer companies. They look for consumer staples. Those are the things that people are always buying, even if you're in a recession. And then there are the defense companies, especially during a time where there's a lot of geopolitical conflict. Well, wars continue happening, and wars get funded, which creates also investment opportunities. So let me wipe off this part of the whiteboard, and then I'll explain these types of ETFs. When recessions happen, investors want to put their money into a place where there's a little bit more safety, and companies that are paying out dividends are generally your bigger profitable companies, because in order for a company to pay out a dividend, they have to have a big cash profit. And out of that profit, they can do three things. They can save this money for an emergency, they can reinvest this money back into the company, or they can give this money away to their shareholders. So if companies during a recession still have money to give away to their investors, those types of companies, those types of stocks tend to become hotter investment opportunities when markets go down. Now, that doesn't mean that they're not going to also go down, but you'll start to see more investors look for those safer investments when markets are going down, because when markets are going down, people stop making as many risky investments. They want the safer investments. So those dividend-paying investments can be more attractive opportunities. So let me go over a couple examples. Example number one is NOBL, Noble. This is an ETF that gives you exposure to S&P 500 dividend-paying aristocrats. What that means is that there's three tiers that a stock has to meet in order to be in this fund. Number one, it has to be a part of the S&P 500. That's a group of the 500 largest companies in the stock market. If you're not one of the 500 largest companies, you don't make it into this fund. Number two, you also have to be paying a dividend. So that means you have to be profitable enough to pay out a dividend to your shareholders and elect to do so. If you don't pay a dividend and you're not in the S&P 500, you don't make it into this fund. And then tier number three is you have to be a dividend aristocrat. That means not only have to have been paying a dividend, but you must have increased the dividend every year for at least the last 25 years. Which means, yeah, there's not a lot of companies in this NOBL fund at the time we're recording this video is paying out around a 2% dividend a year. But from the dividend play, this is one of the safest options out there because it is extremely difficult to be in this fund. Option number two is VIG. This is another fund that's very difficult to get into. This is a fund created by Vanguard that is investing in companies that are number one, high dividend, but also appreciating dividends, meaning this is focused on the larger companies that have been in the game of working to increase their dividends every single year. So these two dividend plays are not going to be the most aggressive, the most risky, more of the safer plays that when markets go down, people want safer investments. These are the types of funds that could see more inflow, which could benefit the funds. I'm not saying that they're not going to go down when markets go down, but you'll start to see more safety and more investors start to dump their money into funds like these when things get risky. The second more defensive play would be to invest your money into consumer staples. Again, these are not your aggressive, fast-growing companies. These are the companies that are producing products that people need on a day-to-day basis. Soap, body wash, groceries, toothpaste, Coca-Cola. People spend money on these things whether you're in a recession or an economic boom. And this can create opportunity as a more of a safer investment. Again, when I say defensive here, I mean safer investment during these downturns. And we have seen in the 2000 dot-com bubble and the 2008 crash that during those times, defensive stocks actually were not hurt as bad or actually went up while markets were going down. A couple examples of ETFs here are XLP and VDC. XLP is an ETF created by State Street that gives you exposure to consumer staples, and VDC is an ETF created by Vanguard that's also giving you exposure to consumer staples. XLP has about 37 stocks in its fund. VDC has about 106 stocks in its fund. So this is going to give you more broad exposure. This is going to give you more niche exposure. Again, I'm not telling you what to invest in. I just want you to start thinking like an investor and understand that there's a lot of opportunities out there depending on what it is that you want to invest in. And then of course there are true defense stocks. And I just say this because there's been a lot of geopolitical tensions lately, and even during times of recession there can be wars. And when wars happen, well, certain companies are producing products for those wars, things like ammunition and tanks and guns and artillery. All these things are produced by private companies, and there are ETFs that can give you exposure to those types of funds. Again, these tend to benefit more during times of tension and hostility, so just keep that in mind. And a couple examples here are ITA and PPA. ITA is an ETF created by iShares that gives you exposure to United States aerospace and defense companies. PPA is giving exposure to the Invesco fund, which invests in aerospace and defense companies. ITA has about 39 stocks in its fund. PPA has about 60 stocks in its fund. So again, this one's going to give you a little bit broader exposure. So we started this video talking about two things. Number one, recessions always happen. There's always going to be a recession coming. When is it coming? Nobody knows. Now, yes, there are some concerns happening right now with AI stocks being in a bubble. There's concerns about our national debt. There's concerns about we have this everything bubble going on where every asset is breaking record highs with inflation still going on. There's concerns, but we don't know when the recession's coming. Number two is we also know recessions create more millionaires than any other time. That being said, we also know that there are certain funds, certain things that tend to benefit historically when these downturns happen. And those three things that we've seen throughout history are gold, treasury bonds, and certain defensive stocks. Now, every single recession in the past had a different needle that popped the bubble. And depending on what the needle was, certain stocks benefited more than others. For example, during the year 2000, when the dot-com bubble burst, we saw a lot of defense companies benefit because of 9/11 that happened. And we also saw a lot of consumer staple companies benefit because people continued to go to Walmart and buy the general groceries that they would have needed. During the year 2000, when the housing market burst, we still saw a lot of tech companies benefit because they were newer, a lot of money was going into tech, they didn't have as much debt as they had today, and they were making big profit margins. It was a newer industry during 2008. So tech benefited along with consumer staples for the same reason as 2000. During the year 2020, when the pandemic happened, we saw a lot of health companies benefit, pharmaceutical companies benefit because so much money was going in to try to help counteract the pandemic. And we also saw work from home companies benefit because, well, people were working from home. Now, despite the nuances during each recession that we've seen a few common trends. And those common trends are number one, gold, treasury, and defensive stocks. But there's concerns with all of them. I mean, gold prices have been booming even though we're not in a recession, even though concerns about inflation have gone down. Either that means that people are really concerned and there's a big problem brewing, or it could also mean that there's a gold bubble brewing. We don't know what it exactly is because hindsight will be 2020. Of course, I have my own opinions, but this is where I want you to start thinking like an investor to understand how markets work. Number two are treasuries, because when things go wrong, people want to go to safety, and historically, treasuries have been one of the safest investments because it's backed by the United States government. But of course, there's concerns with that too, because of how much debt the United States government has. Yet, at the same time, the United States government is still the most powerful country, and we have the most powerful currency in the world. So I want you to understand the pros and cons of all of them. And then we have defensive stocks, which is when downturns happen, people want safety. And what are those safer types of investments? It can include things like dividend-paying stocks. It can include things like consumer staples. And of course, it can include things like national defense-related stocks, especially during times of geopolitical tensions. That being said, we know that history doesn't exactly repeat itself, it does rhyme, but we don't know what's going to cause the next one. And this is where your goal is to be financially savvy. That way, when the downturn happens, number one, you can protect yourself, but also number two, you can capitalize on opportunities when that happens, because a lot of people are going to be blindsided. I want you to be prepared that we have the money to capitalize on buying good investments when they go on sale. Again, if you want some more resources on how you can get started investing, I have a free investing masterclass for you down in the description. And if you got value out of this video, the best thank you is a referral. That way we can continue to spread this financial education. So if you could, please share this video with a friend, family member, colleague, or fellow investor. Thank you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.